Hello, everybody. Good afternoon. As Tracy mentioned, my name is Corey Sovine. I'm the Senior Vice President of Retail with Colliers International here in Milwaukee. And I got to tell you, I'm really excited about this panel. We have some major heavy hitters in this industry right now here, some real what I would call influencers, people who actually direct retail policy as much as anything else. So with that said, we'll get right after it. We got a lot of material to cover. I'd like to introduce our panelists here. First, we have Megan Martindale, who's the Global Head of Retail Research with CBRE. Derek Brown, who's the VP of Americas and the Head of Retail Research with Cushman & Wakefield. Angie Solanki, who's the National Director of Retail with Colliers International. So thank you all for coming. Very appreciative of your time. One of the rare benefits of COVID is that you all have time to, pay attention to Wisconsin. Thank you. And I don't know about everybody else, but I'm really excited about, having some knowledge thrown on it here. So let's get after it. As we mentioned before, we're going to have a series of questions that will direct to some of you in particular, but we want this to be an open forum. So feel free, anybody, to jump in at any time. And if you have something that you would like to contribute. So first question is for everybody. When are we going to see Amazon drones and blimps flying all over our neighborhoods?
I wouldn't bet the farm on that anytime soon. They seem to be doing well enough with their existing delivered by truck model. But will drones play in eventually? Yeah, but here's the thing that drives me nuts about everything. Is that what looks like a good idea, if you can't make money off of it, isn't a good idea. And we see that again and again and again and again.
Yeah, I would echo Garrick. I mean, I think it largely depends on where you live and what their reach is from a last mile perspective to some of these markets, but you're going to have major restrictions on that. And again, if it's not profitable, there's no reason to roll it out.
Yeah, I would echo what Garrick and Megan have shared. And don't forget, there's still so much reinvention with retail. Look what we're seeing as it relates to big boxes, Amazon Fresh, etc. So it may seem exciting, it's new, it's fresh, but it's an innovative idea, but it's going to take some time before we see at least drones landing here in urban markets.
As a footnote to that, some of you may have seen, and I did read about this maybe a year ago even, that Amazon had patented technology of effectively a delivery truck with a gigantic 3D printer in the back. It would just circulate around neighborhoods and literally print goods out as it was going to fulfill them to people's houses. And this is like sci-fi kind of stuff at this point. It's just crazy. So, anybody? Good. All right, moving on. So, Megan, this question will be for you. My feeling is that COVID has not materially changed much about the current retail trends. It really only accelerated them, in some cases throwing gasoline on them, in other cases rocket fuel. Do you agree? And if not, why? Or if so, why?
It's yes and no. I mean, I think we all know that accelerated is the number one buzzword of 2020 in terms of all of the applications across multiple industries and certainly our beloved retail sector. I think, yes, I agree in terms of it accelerated a lot of structural shifts that we were already seeing underway. So the growth of e-com, the demise of the department store, what that means, from all vulnerability, decline in apparel, segments, looking at the U.S. and looking at, candidly, our oversupply of retail and what that means from a stock level perspective and how we look at adaptive reuse and conversion and mixed use, et cetera. On the other hand, though, where I would disagree is that, COVID has had a direct impact cyclically on the categories that were really thriving before this hit. So F&B, gyms, fitness, entertainment, anything experience driven. And although we were seeing individual companies, that were having balance sheet problems and in trouble or struggling, pre-COVID in those categories, those sectors were largely healthy and thriving and fueling the growth of our industry. And they were the real point of differentiation at a property level. And I am very much believing that all comes back. It's certainly going to take time, but I think those are the trends and that side of it where really we saw a reversal in what we were seeing pre-COVID versus the acceleration of the other items that I mentioned.
Sure. Yeah, I think it's sort of a terrible irony that we've spent the better part of the last decade backfilling vacant department stores with these experiential retailers, and now can't even operate anymore. So,
Yeah, I view it as acceleration and deceleration. I completely agree with Megan. And, you know, the problem with F&B and entertainment and the vulnerabilities there, not just the nature of the pandemic, is that these are a lot of small businesses. And that's a key point of vulnerability. Will there be immense opportunities in rebuilding all of those? Oh, yeah. Totally. But the challenge is can you make it through the next 12 to 18 months?
fair enough. Question number 3. This one is for Angie and Garrick. It has become increasingly clear that true omnichannel is the future for all retail, be that bricks and mortar or digitally native brands. Of the current fulfillment technologies and services available today, you feel like there's one particular silver bullet solution that these retailers have or need, or is that solution yet to come?
I'll go ahead and kick it off. I would say no, there is not a silver bullet, at least that I've seen. And I really look at this as, you know, what we've seen with the pandemic, it's actually accelerated the integration between, you know, online, physical store pickup, curbside, you know, various service models. And really what we need to look at is how retailers are improving that multi-channel dynamic, right? It's more having retailers invest more in providing the capital to enhance the process, the tools, the drivers, etc. I think we've all read as of either late yesterday or this morning, it was clear Nike showed considerable profit from, you know, the current quarter, and that's basically due to a lot of the sales that they saw through those digital channels. So I think it is here to stay. I think becoming a single marketplace, which is having various channels to purchase, is really the conversation we should be having, because that's what consumers want. They're demanding flexibility, right? They want the convenience. They want to have the ability to order online, pick up in store, have it put in the back of the trunk, etc. We're, you know, we are living in this, you know, call it shelter in place pandemic. However, when things do get back, I do see that these demands and desires are going to continue. So from my perspective, you know, I don't see this going away. And so we just need to be mindful of how different channels will augment over the next, call it 12 to 24 months, and what really sticks and stays.
And I agree basically with that premise, but there's going to be big exceptions. Can you make it work if you're a dollar store? I mean, maybe with your high volume items, you can. Can you make it work for off-price apparel? You know, the price points are so low, the building to infrastructure is so high. Once again, we're getting into that issue of, yeah, it's a differentiator, but if you lose money on it, how long is it sustainable? I mean, I think the biggest example of that today is food delivery. Nobody makes money, nobody. The delivery drivers don't make any money, high turnover. The restaurateurs, where, you know, it's a business where you have 10% profit margin, you're a rock star. When you're dealing with 15 to 30% fees, you don't make money. And by the way, the big third-party app guys, Grubhub has had a few quarters of profitability, but 4 out of 5 have been unprofitable. DoorDash is about to go public, which has really big implications for the ghost kitchen craze, you know, because I can see if you could synergize all those costs and make it make sense. But if you can't, then all it is a predatory model that eats up these small businesses that are not savvy enough to understand in the long run they're not going to make money from it. And we don't have an endless pool of restaurateurs anymore. You know, it works when there's always someone thinking we need to be on there. But if we lose a third of our restaurants, which is what I'm expecting, how well does it work?
You know, you made an interesting point there about the grocery too. I've noticed certainly in my own local grocery store, you know, countless guys with huge carts just going up and down the aisles, you know, clogging the aisles in many cases, just going down their checklist. And I'm thinking to myself, these are basically personal shoppers for all of these individuals who are ordering these services. And how is that feasible? Is the consumer going to be continually willing to pay whatever upcharge is necessary to make that a feasible model in the long term? So yeah, it's fascinating. So building on that, can you give me one example of a retailer right now that you think is doing it really well?
I would say that, Target, I think, has actually been on target. They have seen the most growth as it relates to the multi-channel offering. I know that they saw a nice pick when we kind of went into shelter in place early on, where people were going out trying to purchase non-essentials such as bikes, because we were all kind of craving to get out. So when that occurred, what they noticed was that once that purchase was made from an item that they previously purchased, they thought, they saw an increase in that same customer coming back and returning to the store to buy either, a bike helmet or a lock or what have you. So they did see a nice pickup in those types of transactions, secondary transactions. I also think, when we talk about, sustainability, like Garrick mentioned, it's going to be really interesting to see what sticks and what doesn't stick. I read a stat recently that 60% of the customers that purchased online picked up in stores in the U.S. It was somewhere close to like 60%. And so will that percentage, continue to stay sustainable? I think curbside potentially, depending on the landlord, or the space availability in terms of curbside at a property from a property level perspective. But I think that may stick, and I'd love to hear, Garrick and Megan's feedback on that as well.
Well, I was going to point out, I think the big guys, I totally agree. Target's numbers were off the hook for overall sales, but driven by e-commerce. But then there's some ones that you wouldn't think of. Williams-Sonoma. Now, of course, the thing with Williams-Sonoma is prior to COVID, almost 60% of their sales were online. Who knew that everyone would be at home baking bread, right? Because simultaneously, Sur La Table went bankrupt. Right. And if anything shows, one thing I'm trying to hold out hope for is that the acceleration of e-commerce, no doubt, is going to be a challenge for physical retail. But if we went into this with apparel, a third of those sales being online, and by the end of the year, I think it'll be 40%, how much deeper penetration do we get? Are we about to enter a period where e-commerce is less disruptive? Instead of that 15 to 20% growth every year, while overall retail was 2 to 3, that we start to see the template, that, okay, we now know how much we need for e-commerce, how many stores we need, and that disruptive period may be coming to an end, but unfortunately, it's going to be after immense pain.
Yeah, we're looking at that carefully too, and just in terms of where does the first e-com surge of 2020, given the shutdowns, and now heading into the second e-com surge of 2020, which is going to be holiday, where does that stabilize and reset in 21, and then what kind of growth do we see from there? Because I don't think it stays at these elevated levels, and then to Garrick's point, continues at these robust growth rates. We're going to see that kind of reset. And I think back to just what Angie said too on the curbside, while curbside is so convenient for consumers, it's not been without its challenges. And, retailers also want to get those consumers back into the stores, because that's where the conversion and the impulse buys and the higher ticket starts to happen. So that's going to be a really, I think that key balance to strike is how do we preserve the physical retail store experience for consumers coming to shop brick and mortar, while providing that sort of convenience, value, and agility factor to fulfill the digital sales out of the stores as well.
Fascinating. Megan, coming back to you. Changing generations and cultural preferences are driving a tremendous amount of disruption in the business world right now, and retail is no exception. Is there a future for retailers that do not have a social mission or message beyond just providing great goods and services?
Well, I definitely think this is something that's accelerated. I mean, most major retailers either had already or have adopted a cause. I think you can boil that down to whether it's an environmental cause or, a wide range of social issues. And we have really seen consumers, especially driven by millennials and Gen Z, wanting brands with purpose, with values, and that transparency that comes from that. I think that what's been interesting through COVID is that if you look at, we're in this economic climate, obviously right now where consumers are being, really scrutinizing where they're spending their discretionary dollars. And they're going to want to spend that with retailers, that have these noble causes that the consumer identifies with. I think, we also saw that during crisis number 1 of COVID, we saw crisis number 2 with all the social issues and injustice and rioting and protests and everything we've seen this year, which are going to now be forever synonymous. And if we look at sort of separating out the issues, I think if you look at the social issues, retailers have very quickly pivoted and adopted more cause around that just because it's such a focal point. I will say, though, that conversely on the environmental side in 2020, I actually think we pulled away from that because the concerns over sanitization and safety far outweighed and almost replaced the concerns about sustainability. And when we were heading into panic buying and we saw the supply chain strain and empty shelves, I mean, that fear of scarcity set in with consumers, and they were buying any product anywhere they possibly could to feel that sense of security that they wanted. I think we absolutely come back to that big environmental focus next year, given that we've had some positive effects on the environment from COVID with pollution and air quality and things like that. But we've also seen a lot of negative effects to the impact on the environment with, just additional trash and everything that we're, producing just to provide that sanitization. So I think it's been an interesting kind of confluence of which issues, we're looking at this year, and definitely retailers, are focused on those. It's just a matter of what the number one priority has been this year from an operational and a safety perspective, and then, kind of resuming that next year when we start kind of resurfacing back on the environmental standpoint.
Yeah, you bring up an interesting point with the was everything and the paper straws and whatnot, and now it's like, oh my God, don't refill your own water bottle. You can't do that anywhere. It's just COVID's changed a couple of things, I suppose. Garrick, this one's going to you. Which asset class, strip centers, power centers, lifestyle centers, enclosed malls, urban retail, high street, mixed use, outlet centers, whatever, which ones do you feel are performing the best right now and why?
I think that's a pretty easy one. It's clearly neighborhood community centers with grocery anchors. We tend in this country to define retail by our iconic retailers and by malls. That's only about 8% of the market. By far, the largest tenant category for occupying space are grocery stores. There's about 12 billion square feet, give or take, of space in the US. 10% of it, give or take, for grocery. And the thing is with all the outdoor centers, because there was more of a proliferation right out of the gate during lockdowns of essential categories, you saw this divide in rent collections, where during lockdowns, the strip REITs were getting between 70 and 80% of their rents. The mall guys were getting between 20 and 30%. It's a category thing. And the vulnerabilities that those centers will have, it'll be more for small inline space to small businesses coming back to market. Power centers are going to get that too, but there's going to be some boxes coming back. That said, there might be some opportunistic box users. I don't think it'll take a couple of years. The real challenge when I look at it are malls, outlet, lifestyle, and urban, because the same categories are active there. Apparel, which, apparel and small business, you could say, are the dual ground zeros. But small business, 90% of our restaurants in the US, independents or franchise. Same thing with health clubs, beauty salons, spas, etc. So it's going to be a big divide when the rent resets, which are already starting, kick in. Quality will play into that as well, and regional impacts. But, right now, by far, it's a much better outlook if you own a neighborhood or community center.
Is there one particular property type you'd stay away from right now?
Well, the mall space has to be reinvented, period. We had about 300 Class C malls that were pretty much in death spirals anyways. They don't survive. They become redevelopment opportunities, full on, anything goes, right? The Class A and B, it's critical, in my opinion, this talk about putting DCs there. Don't even get me going.
Come back to that one, so stay on.
Okay, take those dead department stores. Housing is your best bet, multifamily. That ties into some other macro trends, suburban, so forth, which I know we're going to get into. But, the challenge is, do you have the capital to do it? How quickly can you do it? Do you need to bring in JV partners or investors? And these are landlords that like control of their real estate. So there's going to be hard choices for a lot of them. But if you can turn it into a community, reduce your square footage of retail, build, basically pivot, because if you suddenly have 1,000 housing units and over 3 empty department stores, now you can put grocery in, you can put all sorts of other things in. And those restaurants, by the way, they will rebound at your center coming back.
Yeah, there's a local Bayshore town center here that I think they just reduced their GLA by 42% or something like that. They're going to be adding hotel and a significant amount of residential as well. So, that runs in line exactly with what you're saying. So this one's for everybody. The last few years, we've witnessed a shift in population migration away from the typical large metropolitan centers, New York, Chicago, LA, Seattle, San Francisco, and of course the major job centers as well. And COVID has really sort of exercised this work from anywhere mentality that seems to be sticking. We've witnessed it locally in a couple of scenarios. So given that this is likely the new normal, is this a trend, A, you foresee continuing on, and B, do markets like Milwaukee stand to benefit from this as people gravitate to smaller, secondary, tertiary markets away from some of these major metropolitan markets?
I can kick that off, and then Andrew and Garrett can chime in. I mean, yeah, we're another trend that accelerated when you see the migration that was coming out of some of the cold weather climates in the most expensive cities across the U.S. I think what's interesting is last year when we were looking at where the migration patterns were to, and this year now amid COVID, there's still some that make sense and overlap. It's the mid-sized market, Sunbelt, the West. But we've also seen some of that reverse, because last year we were seeing, big migration population shift into Orlando and Las Vegas and Memphis, and a lot of these cities that were heavily dominant with the tourism and hospitality industry. And I think that's going to be a much slower rebound and recovery for those cities. But yeah, when you start to look at some of the mid-sized cities that people have been gravitating to, and I like the term that you use, Zoom town. So instead of like the boom towns, it's the Zoom town, right? So where residents have wanted to de-densify and get out of the urban core, not be reliant on public transportation, and now with the ability to, at least for the foreseeable future, if not indefinitely, work remote, it's driving these consumer bases into the Bend, Oregons, and Boise's, and the St. Louis, and continued growth into Charlotte. And if you're in Metro New York, I'm in New York City, and you can afford it, we've seen a huge migration to Greenwich and Westchester and some of those cities. So I think when you look at a Milwaukee that was the coolest city of the Midwest, according to Vogue, a few years ago, and you look at the fact that it still has the proximity to the big cities, but it also has a more diversified employment and economic base. And it gives you that sort of access to urban culture and lifestyle, while very much being more of a suburban, day-to-day life. And if you have the flexibility from a work standpoint, I think we'll absolutely continue to see the growth there. I do think there is an element of, the cities will come back. If we look back to like 08 and 09, the cities really led the recovery because that's where the jobs were being created. This time around is completely opposite. The suburbs are absolutely going to lead the recovery. But as prices come down in New York and San Francisco and Chicago, there's still a population that wants to live in that city when it feels safe to do so again. And you can get back into the office and resume restaurants and nightlife and museums. And so I think we'll see the demographics and the composition of some of these cities change. And it's certainly another like 24, 36 months before we see this kind of inbound reflex, inbound traffic coming back. But I don't count the cities out. I just think it's a much longer recovery cycle.
Anybody else want anything?
Well, something to keep in mind, the urbanism trend was driven by two demographic groups, millennials, of course, but also empty nest boomers. Sheer numbers, those are the two largest groups. So it was bound to slow as more boomers, unfortunately, wouldn't be with us, and as more millennials were in prime family rearing age, where, suburban schools, need for more space, cheaper cost of living was going to drive many of them to the burbs. We felt that they were going to be replaced, because I still am a believer in live, work, play lifestyles, but replaced by Gen X, smaller generation, and then eventually Gen Z as they enter the workforce. Problem is the Gen Zs that are in the workforce are highly likely to have been impacted by the unemployment situation. They're mostly in service gigs. So they're back on Gen X couches. So in the meantime, what we've got is those who can afford it. July was a record-setting month for home sales. People getting out, people who have been trapped on lockdown in a place like New York or San Francisco, where you might be paying $3,000 a month for a 500 square foot apartment. It felt like a prison. If you have the money, you might be rethinking your relationship with urban areas. Immediate suburbs of the most expensive cities will be the first beneficiary, but secondary markets, if I'm in Milwaukee and I'm a residential realtor, I'm doing everything I can to get in front of Chicago residents that maybe are a little bit fed up at this point.
Sure, yeah, makes sense. And I'm glad you mentioned that with the apartment in New York. I having gone through this COVID with 3 kids and a dog and thinking about being stuck in 800 square feet right now, it's tough. So, as a follow-up question to that, in the at least current trending of people going to some of these smaller markets and everything, how does that impact how retailers follow with the migratory trends of shifting demographics, and how do they perceive different markets, and what kind of analytics and whatnot are they relying on to help them follow the customer? Or do they even need to follow the customer? Can they just wait in the major markets until customers come back?
Again, I'll jump in. It's interesting as we look at this, retail follows rooftops and rooftops tend to follow the jobs. Well, in this case, it's been the residential migration patterns because of the flexibility from remote working that's kind of leading this. But when we're talking with retailers about what their strategy is, both meeting these, migration patterns, but then also revisiting their urban fleet of stores, I think the strategy is it largely depends on what kind of retailer you are. If you're a Fifth Avenue luxury brand or brand that's highly dependent on tourism traffic and the office population being in Midtown Manhattan, this is a very different story than I'm a service-based, pet grooming or vet service or salon or something that's starting to really come back, and I can be in the neighborhoods of Manhattan. So there's a little bit of a delineation there that I think is really key. But I think when you look at some of the city strategies in terms of the urban and high street and kind of flagship stores, a lot of it relates to the rent compression that we're anticipating. I mean, there's still retailers who want to be in the cities, and they're looking at this as a 24, 36 month strategy now instead of a 12-month strategy. But at the same time, as rents are coming down, even though they've been slowing, and in New York, for example, they've been still so prohibitive, that as retailers are starting to see the opportunity with rents coming down and looking at a longer horizon in terms of when you would open a store, how you would position and what kind of traffic resumes, we're still seeing that appetite to look at the urban retail. It's just definitely shifting from a time frame standpoint, and retailers highly scrutinizing occupancy costs because they no longer need to pay for the billboard on Madison or Fifth, but if they get the right rental rate, they have a reentry phase over the next 2 to 3 years as we're seeing the rebound happen and that reentry happen, and then know that they can stabilize 4 to 5 years from now. We're definitely still seeing an appetite for that urban retail. It hasn't decimated it just because everyone's sort of either temporarily or maybe more permanently moving to the burbs.
Yeah, I mean, Megan, you might also, I totally agree with you, but it's also a function of sales, right? So as we're starting to see, these urban cores, due to a variety of things that we've encountered over the last several months, there isn't the sales in these locations have declined quite significantly. So it is a compression in rent, but also, when will they actually start to see a ramp up in sales and foot traffic?
Yeah, and that's exactly what, we're hearing from retailers. So it's like, okay, we're looking at, like I said, like a 24, 36 month, sort of reentry stabilization, get people back into the urban core. This is not, I don't think there's anyone we've talked to from a retailer standpoint that unless you're a very specific use in a neighborhood, you're not looking at a recovery in 2021. You're looking at that much further out, and just in terms of how those deals are structured until to your point, those sales rebound.
Mm-hmm.
Good, thanks. So Angie, this one's for you. Simon and Brookfield, two of the largest retail REITs in the world, are now the proud new owners of a JCPenney. Why are shopping centers buying retailers, and is this going to continue as a trend, or is this kind of a one-time thing?
Well, I think Garrick actually pointed this out earlier, and that is, what you're really seeing is landlords want to have control, as much control as they can, right? And so when you're looking at these malls or projects that have several big boxes, the opportunity is really, it's been there. It's just, I think, been accelerated due to the pandemic and store closures and bankruptcies, etc. But landlords are really looking at how is retail now reinventing itself and moving into a repositioning. So how can they take this project, convert it to more of a mixed use through densification, through looking at other sectors, i.e. Garrett mentioned multifamily, et cetera. There's a whole host of new sectors that are out there that fit really nicely into some of these locations. It's all about the real estate and where it's located and what's going on around them. So, for example, we're working with a couple of our clients and with power centers, and they're actually looking at, converting some of these boxes that they're going to get back in the next 12 to 24 months. And that horizon is perfect from an entitlement perspective, and evaluating what's the highest and best use for either that box or for the project overall looking forward. And so you're going to see more of that. Asset repositioning, it's also going to provide, slightly different risk profile, different cap rates against each of the different categories or product types. So I think that's really going to be, I think that's what we're seeing with Simon and Brookfield and others out there.
Anybody else have anything to add?
I doubt they bought it because they're big believers in JCPenney's viability and vibrancy. But Brooks Brothers, on the other hand, I think that they see a real opportunity there. Menswear is being decimated. It was already struggling because of casual Fridays, and now, of course, with COVID. Brooks Brothers, however, in retail's flabby middle, if you have a niche and you have a fairly loyal consumer brand cachet, if you can acquire them at low enough a price without the debt, makes a lot of sense. My only question for the mall guys is, how much can you keep spending on this while not spending to reimagine your centers? That could become an issue, which is why I think that for the first time, probably not till early next year, you'll start to see not trophies, not A+ malls, but probably some A- malls being offered for sale. because the last few years, if you wanted to buy a A-level mall, you had to buy the operator.
So would you, as an end game, would you anticipate that at some point these retailers all get spun back out, when things have stabilized a little bit more?
Boy, JCPenney, again, I think that's about control of the real estate and buying time. But, that they would eventually go back into growth mode. I don't know how many Aeropostale stores have opened since they were acquired by a group, including Simon. But what I understand is that they were profitable again within 2 years. So it wouldn't surprise me. I mean, one of the questions I hear a lot is, well, can a mall landlord run a store better than private equity or Wall Street? And I'm like, how can they not? I mean, they have skin in the game. They actually care. You're not just an ends to mean or means to an end, which is the challenge with private equity and all too often some of our publicly traded brands, that even if they know better, they have to make the best decision for the next quarter, not for the next 10 years.
Sure. Yeah, I've definitely noticed a correlation between private equity getting involved in retailers and some of the subsequent decisions that were made, particularly in the case of bankruptcies and things that maybe otherwise didn't need to be made necessarily. So, Garrett, coming back to you, because I told you we would. With millions of square feet of box and retail space coming back to landlords, an increasingly smaller pool of retailers to backfill those spaces, are we going to see the Mall of Amazon? Are we going to see, former JCPenney Amazon distribution centers?
Well, Amazon has said they're going to open 1,000 new DCs in their hub and spoke model, but these are going to be final mile, probably 30 to 60,000 square foot players. Industrial real estate's still going to be their cheapest and most viable option. Mall conversions, I only know of 7 in the last 20 years, and that's with about 250 malls that went away. Most became power centers. And the 7 that happened, none had been vacant for less than 12 years. 5 were in Rust Belt areas where population kind of disappeared. The other 2 were built on planned growth. They took a different turn, became industrial neighborhoods. Look, if I'm a tenant, and even with a smaller Amazon DC being brought into my mall, it's one thing for me, if I'm Macy's, to have Nordstrom there because they're our competitor, but they drive traffic. We benefit. You let Amazon in, what you've just done is you are bringing no traffic in, you're just collecting a rent, and assuming you can do it without jamming up the parking lot with trucks, right? Making people even less likely to come at Christmas time. You just made same-day delivery a lot easier to keep people from the mall entirely, okay? If you're not thinking about that and doing these deals, your tenants are going to be pissed, rightfully so. You have let the ultimate fox into the henhouse. I'm pretty militant on that, but I don't think it's a smart play, no matter how desperate any landlord might get for rents if they're trying to keep a sustainable mall. What's more likely is big box. There are more Sam's Clubs that were converted to DCs than any malls. I think it's something like 7 to 1. It's going to be interesting, but I think mostly it'll be an industrial play.
Meg and Angie, anything to add on that one?
Well, I actually wanted to ask Garrick a question, and that is, as online continues to increase, I mean, it's not increasing as we all discussed quite significantly, but I just read something that the requirement for online is going to continue to grow in terms of industrial and somewhere around 3 times in terms of square footage. And just curious, either Megan or Garrick, if you're, where are they going to build all this industrial? And apparently, I know we do have quite a bit of space, but it has to make financial sense, right?
Dead Class C strip malls would be a great place to start. Those aren't necessarily on the primary commercial thoroughfares of, cities are going to be more desperate than before. This is going to happen more than ever. But when they would go through their list of highest and best use, industrial always was at the bottom of that list, because in the old days, it was like, well, can we get an auto mall? We want the tax revenue. And then it would be, all right, well, maybe residential, maybe office, whatever. But, you know, there's an awful lot of defunct Class C retail space for every asset class. It's just a trick with the Class C malls is even the long dead malls still tend to be on the most vibrant commercial thoroughfares in any given city. So, you know, it's going to be interesting. And one thing too is that the number of retailers may go down. I don't see, you know, if somebody makes it through Chapter 11, they're not going to close their DCs because omni-channel is critical. They might do sale leasebacks, but you know, right now I've been wondering for the last few years, why did I decide to specialize in retail versus industrial? Because I'm not this depressing a guy, you know, really, I'm not. But it's a challenge right now.
Those worlds are growing increasingly intertwined these days, it seems.
They are, but one thing I'm so, Corey, I'm sorry if I cut you off. I didn't mean to. I'm passionate about this. You know, because of industrial being the most resilient, even seeing growth this year with all of this, it's so easy just to say, well, just all of retail gets industrialized. And I'm really pushing back on that because while, yes, we're seeing the multi-channel, the omni-channel real estate really start to evolve as a new asset class in this collaboration, in this full integration of retail and industrial, we can't forget that most retailers, most brokers, a lot of retail developers, they'll never really truly touch industrial. It's pure retail DNA. It's operating those stores. Yes, it's integrating e-com, digital platform, all of that, yes. But from an operational standpoint, I think it's easy to jump on the bandwagon that industrial's hot right now, retail's really struggling, so just turn retail into industrial. And when you get into zoning issues and the traffic generation issues that Garrick mentioned, and how we really see that preserving that consumer experience in the stores coming back. It's easy to forget that we like to be in stores when you're in the middle of a pandemic, but people like to be back in stores. We're seeing that pent up demand as soon as we've seen the stores reopening, and we're seeing a direct correlation to e-com stabilizing as soon as the brick and mortar did start to open. So I think it's easy to forget that retail still really matters, place really matters, and not everything is just going to become a DC or a warehouse or have some kind of industrialized component to it. And we have to really preserve that retail DNA of what the stores mean and just how to get consumers back into them and how they feel safe there again.
Sure, I agree. Okay, shameless plug time. What are each of your respective companies doing to best equip your professionals with all the best in class tools, technology, training, et cetera, to make them the best brokers and advisors out there? Don't all jump at the same time.
I'll just kind of kick it off. I think it's important that we continue to share information as a community. This isn't, one against the other. It's really about how do we really try to create a partnership. So I think it's important to see how we can provide our professionals, our retail professionals, with good information, directional information to help our clients going forward.
I would agree, because I think that the nature of retail brokerage is more advisory now than ever before. It's as opposed to transactional. And, the bells and whistles and the tools are great. Placer AI and all the foot traffic stuff is critical. But at the end of the day, if you're approaching retail as a broker about purely transactional, like in the old days, you're going to be struggling. It's really strategic advisory, long, medium, and short-term planning. The relationships are great. They're a lot more time intensive, but I still think that they're really rewarding when you approach it from that point of view.
Yeah, and I would agree. I mean, I think, we all have the tools and the data and the resources, and I think the communication is key. I think what I'm really finding too, given this now my third recession in the business, it's really trying to help the brokers and clients understand this massive paradigm shift that we're in. It was already happening for all the reasons we talked about, and now, we accelerated it by arguably 3 to 10 years, depending on which nuance you're talking about in the industry. And I think part of it for us too is helping a lot of the brokers and our clients really pivot their business, because a lot of retail owners, retailers, brokers, went into COVID with just sort of leasing problems and are coming out of it with fundamental real estate problems. And I think that is really how we're trying to help, is to how to be the solution there. And just understanding that, what is going to come back and what is sort of forever changed, and what that kind of new model looks like going forward at every level.
Okay, great. Well, thank you. One last question here real quick. Thinking forward for each of you, what is, in 2 to 3 words, the theme of 2021 retail going to be?
Well, I can jump in. So I would say, from a retail standpoint, you've heard the word in all the synonyms today. It's retail reimagined. That's what we're really focused on. But I also think, just personally and professionally, when you look at the people who are still really slugging it out in this industry, it's a lot about endurance and just riding these changes over the next 12 to 24 months.
Garrett?
I would say bifurcation, or if lack of a better look, what's going to be happening next year is through the end of this year, the pace of small business failures actually has been accelerating. It's going to get worse before it gets better. The corporate bankruptcies are going to be going at a very high level. I'm talking chains, 20 units or more. We're at the point where it's about 3 a week. That's going to escalate into next year. But by next year, we'll also start to see opportunistic growth. One of the reasons we're not seeing a lot of deal activity is because there actually are players out there that look at this as a once in a lifetime tenants market. They're waiting to see resets. So if you're a landlord, get ahead of it. If you might be dealing with a 20% rent reset by the time we're all done in space that could be vacant for 3 years, get in front of some of these tenants. Offer 15% off of what you were asking before. Stabilize your centers. Nip it in the bud. Next year, we're going to have a bunch of bad news, but we're also going to have a lot more transactions. So from a brokerage perspective, it's going to be really disparate, and it'll be a bifurcated marketplace where winners and losers are more clearly emerging, I believe.
Angie?
Yeah, I would definitely agree with Megan and Garrick, and I just add that, some of the key words that I really look at is, this is the great pause we're going through, and we're going to come out of this with resilience and a corrected marketplace as it relates to retail.
Hey, you guys are all terrible at 2 to 3 words, but well, great answers. Thank you, appreciate it. With that being said, we are out of time. Megan, Garrick, Angie, thank you guys so much. I hope everybody appreciated that. I know I did. I learned a lot, and I'm looking forward to watching it again to see if there's anything I might have missed. So, Tracy, back to you.